Is it rate cuts? Some say be careful what you wish for. All this as Fed member after Fed member says it's not going to happen. So where does this leave us? Let's ask Tom Lee. He is Fundstrat's co-founder and head of research. He is also a CNBC contributor. It is good to see you as always. What do you make of this market reaction today, Tom, to that CPI print?
Scott, I think today's CPI print wasn't like a tiebreaker. I think there was something that people who are constructive on inflation falling, they saw plenty there to like. And then there's people in the sticky inflation camp, and there's plenty of arguments there. So it's sort of been like this all year where it's a game of inches being fought. But progressively, I do think the bull case is prevailing. And if I could just point out, I think one of the biggest implications for this CPI report is the percentage of components that are actually in outright deflation. So if you look at the price level and then where it is now, these are off the peak. It's actually now hitting 40%. That's actually well above the 10-year average of 38% and the 45-year average of 30%. So we're actually sort of saying forward inflation should come down pretty sharply.
Is that your bull case? I was going to ask you, what is the bull case? Is it simply that inflation comes down more sharply than people think? The Fed is absolutely done. We have a soft landing, because that's maybe a lot to ask for.
It is a lot, Scott. I mean, I'd say as some people say, it's a narrow path. What we think is the bull case is that inflation is falling faster than most people realize because we're starting to drop some of the high prints from last year. And that's going to allow the Fed's pause to become more comfortable for investors because it really leads to a soft landing. I still think that's more than a 50% probability. And then when you consider where positioning is, if you look at FINRA margin debt, for instance, there's been more liquidation or deleveraging of FINRA margin debt than occurred in 2008. So people are sitting on cash on the sidelines. Retail money market cash has risen by $500 billion, a lot of it before March, just in the past year. So we've got people sitting on cash. And if we have a soft landing, we know corporate profits have been holding up nicely. So it is a scenario where the bonds are at 3.3% for the 10-year. That allows PE to expand, and that's why stocks could go up.
I know, but speaking of sitting on, using those words, the Fed is likely going to be sitting on higher rates for some time. And even some of the more, let's say, dovish members, like Austin Goolsbee, for example, says he's already getting, quote unquote, vibes of a credit crunch. So if it's higher for longer and we've already got some credit issues coming into the system, that doesn't sound that bullish to me.
No, it doesn't, Scott. Higher for longer would be tough because, again, there would still be a lot of tension between those who think something will break and those who don't. But what I would point out is that another scenario could emerge, and I think it comes from both the public's outcry about high rates and political pressures, is that the Fed could end up tolerating inflation settling around 3%. I know Powell's publicly dispelled that notion, but that does explain why, the forward curve is where it is versus where the Fed tells us interest rates should be. That I think there could be a point where the Fed could end up tolerating something around low 3% inflation. That would be quite good for stocks and profits. But I'm not saying that's the probable case, but I think that's why things could get better.
Do you think they end up cutting this year? Is that in any way part of your bull case?
We don't. I think one reason why the Fed futures are forecasting cuts is people are assigning a probability of an emergency from a regional bank crisis. I mean, that would not be good for stocks, but I think the bond market is trying to price that in. I don't think anyone in the bond market really thinks there's actually interest rate cuts coming, but they also don't think we're going to be at 5% for the next 10 years. So I think the 10-year kind of stays anchored in this low 3% range. I don't know where the 2-year ends up, but it's really going to be the 10-year that really drives where PE should be for the stock market.
So would I be overstating things then to suggest that your entire bull case is built on the idea of a soft landing?
Yeah, Scott, it is based on that. And I know someone will say, look, we're grasping at straws. But as we've written for our clients this year, there have been 6 things that have happened this year that only happened at the start of a bull market, and they've never seen an occurrence in a bear market. So it does seem like the evidence is still showing October was probably the low. We're in a rising trend for the last 7 months. And if I had to explain why this is happening, to me, it would be the best explanation is a soft landing ahead of us.
You know what? Let's expand the conversation and bring in Dan Greenhouse, if we could, Tom. He, of course, of Solus Alternative Asset Management, because I want to have a debate from two market participants, those who follow and watch and actually act in the markets every day. You hear what Tom says.
Sure.
Good to have you, obviously, here. What do you think?
Yeah, I mean, I think there's a lot. Tom is articulating a view. He's not alone in articulating this view.
Is it a credible view?
Well, sure, it's credible. I mean, listen, the Federal Reserve itself more or less is banking on something resembling a soft landing, although the staff at the Fed is predicting something close to a recession. Mm-hmm. But you've got other private sector actors like Goldman Sachs that have been arguing for quite some time that you can have a soft landing in the economy. I think where I take issue with Tom's argument, and I'll agree that I assume he's referring to the stock market, that there are 6 things that are occurring that only occur in bull markets. Where I would take issue is the idea that in order for this to happen, you'd be thwarting 40 years of data and activity on the part of the Federal Reserve. In that when you raise rates, my argument for a year and a half has basically been when you raise rates, bad things tend to happen, mm-hmm. and that's not because of any ill intentions. It's because the odds that 10 or 15 people sitting in a room can manipulate an interest rate in a $20+ trillion economy to fine-tune it perfectly mm-hmm. is fallacious. And I don't think that this time, in that sense, will be any different. I don't disagree that maybe the October low was the, quote, low, but I think the idea that we're not going to come close to revisiting that, at least, I would challenge that.
Tom, what about the idea that maybe what we witnessed with the banks to this point isn't it? And I want you to listen to what Stanley Druckenmiller had to say on the point that Dan Greenhouse is making here, that when the Fed does what they do, and they do it in the speed in which they're doing it now, things break. And maybe the banks weren't the first thing to break. Listen to Druckenmiller. This is from Sohn yesterday. We'll kick it around on the other side.
When you have free money, people do stupid things. When you have free money for 11 years, people do really stupid things. So there's stuff under the hood. It's starting to emerge. Obviously, the regional banks, recently we had Bed Bath & Beyond, but I would assume there's a lot more bodies coming.
What about that, Tom, right? We're normalizing from what Druckenmiller would call way stupid. And it's inevitable that there's something else out there. What do you think?
I mean, he's been proven correct. As we look through the aftermath of things like Silicon Valley Bank, we did see a lot more evidence of sort of mismanaging what was visible risks emerging. I think, I don't want to be glib, but in the GFC, households were the ones really caught off their skis because they were using floating rate instruments, a lot of leverage with zero equity cushion. In this cycle, we know homeowners have actually been a lot more prudent, using fixed rate mortgages with a lot more equity. So the place where something bad could happen is where there is excess leverage and not a lot of equity cushion. In a lot of lending today in the corporate, that hasn't been the case. So to me, I do think things are still breaking and they haven't finished breaking. But like the 90s, where you did have a sort of a persistent banking crisis, it didn't take down the whole economy. So I think one of the things I'm still just using as a guide is that we had a 27% decline in 2022. That's the same decline that Volcker induced with his 9-step inflation war, when he took rates to double digits, and the maximum drawdown on the S&P at that time was 27%. Mm-hmm. He achieved that in 9 months last year. So I think we already had that wealth shock. And now in the aftermath, I think stocks are climbing towards equilibrium.
Yeah, listen, that's all fair. And I agree that I think people discount a 27% drop in stocks, a rise in investment-grade credit spreads from 90 to 160 or whatever. I mean, you had a meaningful reaction in risk assets. I would also disagree somewhat in the larger sense that, like, the banks are the first things to blow up. I mean, you know as well as anyone, the unprofitable tech stocks blew up at the beginning of 2021. More profitable tech blew up, so to speak, at the end of 2022, and you sucked a lot of valuation out of the market. To Tom's point about leverage, which I think is entirely valid, this, in that sense, bears no similarity to what happened in 2008. But to the point, with respect to valuations in the equity market, you see this in the credit market and the equity market, that you're dealing with a situation. We find ourselves in a situation where credit spreads are still incredibly tight and equity valuations are still, for lack of a better word, pretty elevated. A lot of that is because of the largest names being NVIDIA, Tesla, and so on. But with valuations at 18 plus times or whatever, and high yield spreads south of 500, IG spreads nowhere, like nothing is near a problem. And my point is, the only interpretation is that the Fed is going to stick the landing, so to speak. And I hate to keep coming back to the Fed because at the end of the day,
look, all roads lead to the Fed.
Sure, but to borrow a phrase from our old friend, corporate profits are the mother's milk of stock prices. And I don't, the negative repercussions are not leverage or a blow up. It's just simply going to be the economic environment is going to worsen, presumably, at some point, and stocks and spreads are going to start to reflect that sometime in the back half of the year. Something like that.
Tom?
Yeah, I mean, I think Dan's making sort of the point why this is a game of inches. I just would point out a few other things. One, when you look at PE, ex-FANG, it's closer to 15 times. And the two most expensive groups after FANG are staples and utilities. They're the defensive groups. 40% of the European stock markets are at all-time highs right now. In fact, several are at new all-time highs. And Japan is at an all-time high. So when we think about this global inflation war and all the credit risks that people are sort of jawboning about, a lot of developed equity markets are at all-time highs, except for the S&P.
What about Megacap Tech, Tom, which you've been dead right about? You said it was the time when, it was kind of out of favor to start the year, that you thought Megacap was going to have a good year. Well, it's had a year's worth of gains in just a few months. But what now?
Well, our base case for FANG this year was that it could rise as much as 50%, partly because it was one of the first groups to really get hit. But I think as this year has unfolded, it really looks like FANG, and I'm being a little broader, including things like NVIDIA and the semis, are so relevant to how you deal with inflation, whether it's through AI or automation. So these are incredibly important companies. And I think Stan's made that point that you can't really say that you're going to have diminished demand for these products. It's actually going to grow, and there's not new competition. So actually, their ability to make future profits is higher. And that's why I think their PE could expand. And again, that really pulls up the whole market.
I mean, you want to make a case for cyclical stocks over FANG-type mega-cap stocks?
Yeah, I can make that case.
You can?
But sticking with the fact...
No. How do you make that case?
Well, listen.
I mean, when I tell you that the New York Fed's recession indicator spikes to the highest since '82,
sure, today,
and you want me to buy cyclical stocks?
Well, a lot of Fed recession indicators are based off the yield curve, and with the yield curve still inverted, granted, I'd call it 50 base twos tens, I'd call it 50 basis points. It's not as inverted as it was. I'd call it 100 basis points, but still levels that are entirely suggestive of a recession going forward. I'll get to cyclicals in 1 second, but I want to make the point about FANG. Just with respect to the market as a whole, we talk a lot about how the market's holding up. If you break the S&P or the NASDAQ down into deciles, the top decile by market cap, which is going to include the NVIDIAs, the Metas, and the like, are tripling the performance of any other decile, and most other deciles are down for the year. And I know that we've all made this argument that you have incredibly narrow leadership, but with respect to FANG, it really is doing the job in terms of holding up valuations and holding up the market in general. That's not to say that we'd be off 10% or something if they weren't up.
And we've seen this movie before.
And we have seen this movie before. With respect to cyclicals, listen, if you're going to have a downturn in the back half or the beginning of 24, then presumably everyone's going to do poorly. It doesn't have to be a 2008 type scenario, but if we're going to crimp corporate profits even further, then it's going to be pretty hard for any sector to rally. What I would argue about something, let's say like energy, for instance, you continue to have secular tailwinds to the space. Oil is off by, call it 13, 14% from the highs. Some of the large cap names are down 4 or 5%. They should be down much more with oil off by 15%. There are fundamental secular reasons at work in some sectors that are larger than just simply the Federal Reserve.
All right. Thank you for being here. That's Dan Greenhouse. Tom, thank you. As always, great day to have you on. This is the kind of day we wanted to hear from you. And by the way, don't miss Tom Lee at our virtual